I backtested the Golden Cross strategy on 8 years of real market data, not one asset. 3. S&P 500, Nasdaq 100, and the Dow Jones. This is the classic moving average crossover setup, the 50-day moving average crossing above the 200-day moving average taught in nearly every beginner trading course. Everyone repeats it. Almost nobody actually backtests it. So the real question is simple. Does the Golden Cross work, or does it just sound like it should? I tested it properly, against buy and hold, so you don't have to take anyone's word for it. Here is my exact method, and it matters, because most backtests you see online are quietly lying to you, sometimes without the creator even realizing it. 8 years of daily price history, downloaded directly from real market data, not simulated, not synthetic. Every signal only uses information that was actually available at that moment, no look-ahead bias. The trade only enters on the next candle's open, never on the signal candle itself, because in real trading, you cannot buy at a price you have not seen yet. I also split the entire dataset in half before testing anything. 5 years to build and test any idea, 3 years locked away completely, untouched, only checked once at the very end. That second half is called out of sample data, and if a strategy cannot survive it, the strategy was never real to begin with, no matter how good it looked in training. Let's start with S&P 500, the benchmark everyone compares against. Golden cross triggers, I go long. Death cross triggers, I go flat, sitting in cash. Simple rule, fully mechanical, no discretion, no cherry picking which trades to take. Over 8 years, the Golden Cross strategy returned about 130%. Buy and hold, just holding the index and doing absolutely nothing, returned 215%. The strategy lost to doing nothing. Nasdaq 100, ticker QQQ, same exact rule, same exact logic. Strategy returned 333%. Buy and hold returned 349%. Closer this time but still trailing. Dow Jones, ticker DIA. Strategy returned 60%. Buy and hold returned 146%. The biggest gap of all three assets and the strategy's weakest showing by far. 0. Out of 3 assets, the Golden Cross strategy beat simple buy and hold on exactly 0 of them. Let that sit for a second, because this is the single most repeated trading strategy taught to beginners anywhere online. But here is where it actually gets interesting, because everyone defends the Golden Cross with the exact same argument. It protects you from the crash. It gets you out before the real damage happens. So I tested that specific claim using maximum drawdown, the worst peak to bottom loss across the full 8 years. On the S&P 500, the strategy's maximum drawdown was completely identical to buy and hold. Same exact worst case loss to the decimal. 0 protection. On the Dow Jones, the same story again, identical drawdown, 0 protection. Only on Nasdaq did the strategy actually reduce the drawdown, and even then, it still trailed on total return. The number one selling point of this entire strategy did not hold up on 2 of the 3 assets tested. Now the part almost every trading channel skips entirely, because it is the part that actually proves whether a backtest means anything at all. I split the Nasdaq results specifically into the in-sample period and the out-of-sample period. In sample, the first 5 years, the Golden Cross strategy actually beat buy and hold. 150% versus 124%, a real edge over the benchmark. If I had stopped the analysis right there, I would have uploaded a video confidently telling you this strategy beats the market. But the out-of-sample period, the 3 years I never touched while building anything, told a different story. The strategy was still strongly profitable, up 333%. That's not a failure by any normal measure. But buy and hold returned 49% over the same stretch, which means the edge the strategy had over the benchmark in training simply did not carry over. It didn't collapse, it didn't lose money, it just stopped beating the index the way it had before. That distinction matters, because a strategy quietly losing its edge looks completely different from a strategy blowing up. And conflating the two is how people misread backtests. One more honest caveat before you take any of this as final. None of these numbers include trading commissions, bid-ask spread, or slippage. Real execution costs would push every one of these strategy returns even lower, never higher. So here is the actual takeaway. The raw Golden Cross strategy, tested properly across 3 real assets with a genuine out-of-sample check, does not beat buy and hold, and does not reliably protect you from drawdown either. If you have ever paid for a course or followed a guru selling you this exact setup as a proven system, it is worth asking them directly whether they ever tested it out of sample. Most never have. This does not mean moving average crossover strategies are worthless. It means the raw, textbook version that gets copied everywhere is broken, and if there is a real edge hiding in here, it has to come from somewhere else entirely. In part 2, I am taking this exact same golden cross signal and testing one specific fix, tuned only on the in-sample data and checked against the out-of-sample period exactly once. No peeking, no do-overs. If you want to see whether a fixed golden cross strategy can actually beat buy and hold, subscribe and follow this series from here. Drop in the comments which filter you think would fix it first, a volatility filter, a trend strength filter, or a volume confirmation filter. I will test the top comment in part 2. Trade systematic. Verify everything.